Welcome, everyone. My guest today is Lead Analyst Logan Mohtashami to talk about the new trade deadlines and how mortgage rates are affected by tariffs. Logan, welcome back to the podcast.
It's so much nicer being on 4 times a week, isn't it? You know?
I don't know. We haven't. I guess we did it last week. Actually.
But by the way, before we go talking, I just want to say my condolences to the ladies out there, because if you're looking for a 6'5" man in finance with blue eyes, if they're telling you that people should dump their homes because the Japanese debt is out of control and wages are spiraling out of control, and that's going to push yields up here longer, and ladies, just toss them. If men start talking about that, he's no good.
Is
Never.
this some thread that's going on? Like what? That seems so random.
No, what do we say about men on X or middle-aged men podcast stock traders? Stock traders do not understand that people live in their house, they have sex, they have children, they go to work. It's what they do. It's a lifestyle choice of how they live their lives. They're not on margin 24/7 running around. And, the new listings data was a perfect example of why middle-aged men podcast stock traders should not be listened to rushing to sell out, because, no, it's 2025. And we had just a stupid question on X. And I was just like, homie, your wife's going to leave you, your girlfriend's going to leave you, you're going to be homeless. That's what's going to happen. Okay. So ladies, if they're talking about that stuff, just toss them. It's not good material.
I like it. You're going for the different angle. You're not talking to the stock traders. You're like, no, let me just talk to the women and say, don't put up with this nonsense.
Don't put up with this nonsense, man.
Okay, well, speaking of nonsense, let's talk about mortgage rates and where we are and what you think is going to happen next.
So we wrote an article yesterday. When this comes out, it'll be Wednesday morning, but kind of like what the Fed is really thinking about, because a very interesting data line came out on Tuesday. The Fed's inflation expectation data tanked, right? They're looking out, 1 year, 3 years, 5 years. It's starting to go lower on the consumer side as well. So obviously, the trade war headlines push people to think that inflation was taking off. Now, my argument is that the Fed doesn't care about this because they have their own agenda, really, with the growth rate of inflation in the second half. But in theory, that would be a very good piece of news. But since jobs week, when the 10-year yield got to 4.21 and mortgage rates were down there, I didn't think we warranted to be there unless the economic data was getting weaker, primarily labor. And the labor data, everyone could question that jobs report, but bond traders just took it and say the labor market isn't breaking, Fed isn't going to. It gave Powell cover to not cut rates. But now with the trade war, we got to make deals. We sent letters out. I don't know if we heard back from the Penguins yet on what they can buy. But in any case, the bond market does not act well with the trade war. And a really good example is early on when the 10-year yield got to 4% and Godzilla tariffs. I mean, I was literally saying, hey, listen, we don't belong down here where Fed policy is at. So we had a really sharp reversal in the yields. But the bond yields, when there's less clarity on the trade war, yields tick up a little bit. Now, the difference now than earlier in the year is the spreads are acting better. The market is generally more calm. But we have a deadline now, August 1st. And the bully ball tactic, has not provided we haven't got 90 deals in 90 days or anything like this. So one thing to think about going out for the rest of this month is, how does the 10-year yield and mortgage spreads act if we get closer to August 1st and there's no deals done? Or very limited progress. That'll be the interesting aspect for the next few weeks, because President Trump said this is a firm, there's going to be no extension from August 1st. But to me right now, it's still acting much better than what it did earlier in the year. Earlier in the year, Godzilla tariffs just threw everyone into a hurricane, right? Stocks were down over 20%, bond yields shot down lower, made a huge reversal. The market was disoriented. Now the market's a little bit more calm, and we'll see, because to me, progress being made on trade deals, right? If we put a lot of time and energy into that rather than investigations, then, the Federal Reserve can maybe say, okay, we could get a little bit more dovish. So I don't believe we're going to get a rate cut, even if the jobs data was bad. That's just not the MO of this Fed. But we should kind of look out and see, should deals be done before August 1st, especially before the Fed meeting? Will Powell and the crew start thinking a little bit more dovishly, or have a more dovish tone going out in the future? Or, we get inflation report next week, inflation picks up a little bit hotter, trade deals get worse, stuff like that. That would be a negative. And that was the point of the article we wrote yesterday, to kind of say, okay, we got these things to keep an eye on, and we have a deadline in August, and the Fed meets before that deadline. Most likely you're not going to get a cut, but you could get a victory in terms of maybe a little bit more dovish stance.
Okay, so maybe make it more clear. Like you said, the bond market doesn't like the trade deal when they're not done, when it's in this sort of like, we don't know what's happening.
Less clarity. Bond yields have been able to tick up, and also there's a global bond yield factor into this. I won't bore people too much with that, but bond traders know that Fed wants to see deals done, right? So we've had a big move in the 10-year yield from 421 to 443. We're nothing too dramatic with where Fed policy is, but this is a really good test case now that we went through Godzilla tariffs, and Bassett had to sneak into the White House and get Trump to tweet and put a delay in there, when Navarro was gone. Now, is this going to be a much more calmer marketplace? And this is a perfect 3-week period to test case this, to see what comes out of the negotiations, what deals are made, what deals aren't made. How does the bond market react to inflation data? What about the jobless claims data? It's a good short-term period to think about mortgage rates going out for the rest of this month.
Well, that's what I was going to ask you. Like, tell me what that means for mortgage rates. You said you talked about the bond market. If I'm out here and I'm like, what does that mean for mortgage rates?
Mortgage rates should be hovering around this level, because we've already had a move higher, until the economic data starts to get weaker. And that's why I didn't think that when the 10-year was at 421 and mortgage rates got to a recent low, I said, okay, we're really pushing it now, because unless the labor data is really bad, we should reverse. We did reverse. So going out, we need to be mindful of every single day something new can happen and could change your business. That's why we have Logan Mohtashami on Instagram stories 24/7 all the time, to take a look to see how the bond market reacts to this. We enjoy the Instagram family a lot. But going out, there's not a lot of labor data except for jobless claims. And then going out, we do have to see, how does the bond market react? I mean, let's just assume, let's say somehow we get 9 trade deals within like 2 days, and the 10-year yield acts lower. That's a positive in the future, because the Fed has told you, we would like to cut if we get some deals or get some clarity. So I think this is a good test case, because what happened earlier in the year was chaos, and you can't operate in chaotic. Rates move way too fast, and the spreads got really worse. We lost about 25 basis points on mortgage rates. So we should be hovering around here until we get either deals or the reports come out either positive or negative for that. This is why we track stuff daily, to see how the market reacts. And a positive thing is that the spreads have gotten better. So there's limited damage to the upside now when the 10-year yield goes up. But mortgage rates pricing do rise. They rise up slowly, but they don't rise up as much as they did early on in the year. This is why the 7.25 was my peak forecast for this year, assuming the spreads get better. We got close to 7.25 the second time around when the spreads got worse. But unless the spreads get bad, we should not be at those levels again this year.
Is there a trade deal that you think could move the needle more than others? Like, if this comes in, that's really going to make a
Japan
big
and India.
Okay.
Japan and India. The rest are, I mean, some of these countries are so poor that you're not going to get the trade deficit any better. They don't have a lot of money in these, they're very poor countries compared to the US. But Japan and India would be big headlines. Those are, when we think about big economies around the world, Japan and India are the two, outside of the US and China, of course. and the UK. But outside of that, these smaller deals, maybe not so much. But I think right now the bellwether is Japan and India in terms of getting something done. Of course, Trump has gone out there and said, we're going to put an extra 10% tariff on anybody who is dealing with the BRICS because they're anti-American, which is funny because the anti-central bank people are almost pro-BRICS people because they say, the dollar's going to collapse and, the BRICS are going to take over, which is hilarious to me, by the way. In any case, be careful of crazy headlines too in the next few weeks. But I think Japan and India would be key.
You know what's great, Logan, is that you keep up with all of that so the rest of us don't have to. Like, what does this faction think? What does that faction think? What does it mean? And, I'm glad that I go down a lot of rabbit holes. I'm glad I don't have to go down those. You can just summarize for us what's happening.
I'm an agent of chaos. I love being down in the devil's pit, fighting everyone. It's a lot of fun for me. But yeah, this is a really good month to test case everything because we extended the deadlines and the president is known to just come out with some random stuff, and we'll see how it works. But obviously, the bully ball tactic didn't work as fast. And they asked Peter Navarro, "Hey, Pete, what happened to your 90 deals in 90 days?" And he's like, "Well, these countries, they had it too good. They didn't want a deal." So we'll see, but and we'll see if the deadline gets passed or extended on August 1st. But I think this is a really good test case. Like so far to me, the bond market and mortgage market are performing a lot better now than they did after Godzilla tariffs. So and inflation expectation is falling for the Fed and the consumer. That's a positive. I don't think that moves the needle too much with the Fed, but generally people see the country likes it when there's less trade war or crazy headlines. That is all positive for mortgage rates down the line. We get deals, we move on with this stuff, and take the next leg forward. But we got a few weeks to test this out.
All right, so we've talked about a lot of things. Let's talk about purchase apps, which will be out by the time that this comes out, although we haven't seen them yet.
Yes, and a gentleman asked a very good question. Because people start reading and they see 22 weeks of year-over-year growth and they go, what is this? Nobody's going to talk about this. And it's funny because I talked to CBS National News recently and I showed them the data and they're going to come out with a piece about our work on this. And they were so surprised that they're like, what is this? And we had our pending sales. Let me tell you, it's so much fun for me to like show people that have never seen our tracker data, like all this stuff. And then like, I think people are so visual that you can say something, but if you show it in a chart,
yeah,
that's why the chart daddy was created. This is my job 24/7. And we showed this stuff. They're like, wow, that's amazing. But the gentleman asked about what happened last year. Was there any year-over-year growth? This is very interesting. Last year, the purchase application data at the start of the year was extremely negative. We had 14 negative prints, 2 flat prints, 2 positive prints, no year-over-year growth. The volumes weren't crashing anything big, but there was nothing going on. And then I believe April 30th was the peak of mortgage rates, around 7.5%. And then mortgage rates started to go lower. What happened then is that we didn't have any year-over-year growth in purchase apps last year until the end of September and then all of October. And mortgage rates didn't get below 6.64 until early part of August. But what occurred last year is that the year-over-year data was negative for many months. Rates went lower and everybody said, oh my God, housing demand is still falling, except the weekly data were getting positive. This is why we have the tracker. And we said, no, you got to track the weeklies here. And we just had, 18 weeks of positive data, more on the week-to-week side. So what occurred is ebbs and flows, right? We talk about waves in economics. And when you're working from a lower band of sales, that weekly data getting better really improved the sales data. Sales data was very negative from June to October, and then it increased the home sales data a couple 100,000 without any negative, like we had negative year-over-year data on purchase apps, but the data got better. So it was until end of September and October, and then November and December for purchase apps after COVID tends to be the early seasonal kick in demand. So we didn't have any positive year-over-year prints until that period of time, but purchase apps look out 30 to 90 days. Everybody saw the negative year-over-year data. They didn't care about the purchase apps. They said home sales are falling, and then it had a couple 100,000 increase. And that's why we created the tracker, because our pending home sales actually verified it. And in fact, that was in September and October. I said, darn, I'm going to lose my price forecast, right? I'm going to lose my price forecast because our forward-looking data is getting better. And this is how you track housing economics, with models, not with a terrible YouTube page or just a horrific Instagram. My God, Instagram has some really bad people too. Lord have mercy. But in any case, there's how you got growth in sales, and we ended up just a little bit above 4 million. So it'll be interesting to see how the second half of 2022 goes, especially if mortgage rates could get below 6.64. That's when the data has gotten traditionally much better. We're seeing this year-over-year growth because we have extremely low comps, so we have more new listings. But it will become more exciting and interesting if rates could just get down. And I would tell you this: one of the shadow Fed president, Kevin Warsh, that Trump parades around at events. And Trump came out this morning and was like, too late. It's like Too Tall Jones. Homie brought out Too Tall Jones. For football fans, you know that. He's like, I was laughing. Kevin Warsh, who is generally known as a hawk, that a lot of Wall Street people don't want him to be Fed chair. He even said, oh yeah, we could cut rates a lot. We have to, bring down the Fed's balance sheets, but housing is in a recession. So there is the shadow Fed president basically trying to make a case for lower rates because housing is in a recession. And remember, on the economic side, it's the residential construction workers and residential investment that matters more to the economic cycle. And for him to say that, it just makes the whole shadow Fed president interesting in the second half of 2025. We're Team Waller here, and it's not Team Kevin Warsh, but it is, if they start talking about housing being a negative for investment and jobs, that'll be something bullish going out, because they've never cared about the housing market for years. I mean, there's nothing going on. All we did is have Neil Kashkari have a panic attack when mortgage rates got down to 6% and we got a little bit of growth of demand. He's like, oh my God, no. How are we supposed to balance an economy if people are having sex and buying homes? If they leave that mindset away and go into, well, housing is in a recession and we know how economic cycles work, and Logan keeps on showing that chart all the time and he's right about that, then it starts to get a little bit more teeth into the policy talk out there. So very exciting month of July going up to the deadline in August, and very exciting for the second half of 2025. And we're here for it 24/7, 4 times a week, award-winning podcast, Sarah Wheeler and Logan Mohtashami together, the dynamic duo, or the Wonder Twins unite.
The Wonder Twins.
There we go.
Yes, absolutely. I wish that you would say something like, we're going to see rates down towards 6% by X date. But I know you won't do that because you don't predict things like that. You give us channels.
Sarah, we create models for that. We don't. And models say that the only 2 times that mortgage rates got down towards 6% was that the bond market anticipated major weakness in the labor data or the economic data, and it drove the 10-year yield down to 2 key levels: the Gandalf line, you shall not pass, and the Hodor line, hold the door, right? And both times they were rejected. So if we get more rate cuts in the system, getting that bandwidth or that bar lower, it makes it easier, right? If the Fed funds rate was at 3.5%, it's easier to get to 6%. Spreads could even get better in that environment. We're just not quite there. We don't want to tell people, like, remember all those people that thought mortgage rates are going to get under 6% because the growth rate of inflation is going to fall, and that. No, that didn't work because Fed policy is up here. If you want that, you got to get Fed policy lower, and then it all kind of works together. But there are other variables in play. So no, you're not getting a simple answer. You should know better, because every time you've asked me this for the last few years, I don't give you the simple answer.
I just said I wish I could. I didn't say I was going to, because I know you won't. But it is good news, at least, that the federal government is like, housing's not doing so well. We should pay attention to that. We should do something there. We'll see what pans out there. Logan, thanks for being on again. Another time this week. Always appreciate it. And we'll see you again soon.
Pleasure.